Good afternoon, everyone. Welcome to day 4 of our strategic virtual financial reporting workshop. Today, we are going to start from where we stopped yesterday. Yesterday, we introduced ourselves to accounting for taxations, where we focus much more on tax regulations and accounting with respect to current taxes. And today, we'll be looking into deferred tax from the consideration of IAS 12 in line with international financial reporting standards. And that's where we are going to start from today. And on that premise, we are going to more or less look at what we discussed yesterday. If there is one or two questions that might need attention from my humble self, please kindly share with me, and so that we can be able to discuss it together. Okay. Any question from what we discussed yesterday with respect to accounting for other form of taxes, which we call transaction taxes, and from the aspect of current taxes we discussed? Any question? Okay, let me give access for any of you to unmute if you have question or you have contribution. Okay, we'll await your question or contribution. Otherwise, we'll move from where we stop. Okay, let's start. Now, today we'll be talking about deferred tax, and we'll try to understand and appreciate what deferred tax is. Though yesterday we introduced a little bit of it by saying deferred tax is no tax, okay? But I believe we need to expand further to be able to appreciate and understand what we are talking about. But if you recall, we discussed it yesterday that income taxes comprises of two components: current taxes and deferred tax. And our conclusion yesterday is that current taxes are actual taxes payable to the tax authority based on current period performance or based on current period profits. Okay. But what then is deferred tax in all respect? Now, we could conclude and say deferred tax is a mere accounting requirement to carry out necessary adjustments to current tax in order to reflect certain consequences or implications arising from financial transactions that was not taken care of in the period to which those transactions relate with respect to current taxes. Now, let's break it down. What deferred tax is saying is that current tax, though, is based on taxable profit, but taxable profit is not derived necessarily from accounting principles, but rather taxable profit is derived from tax rules, which in one way or the other varies from requirement of accounting principles. Though there are situations where tax basis or where tax treatment of transaction aligns with accounting treatment of transactions, but there are instances where they do not align. These instances is what makes taxable profits different from accounting profits, which then means that tax derived from taxable profit will not be necessarily a representation of accounting profit once you apply the tax rate on it. In that case, it means our income tax, if we consider it only with respect to current taxes, will not be a reflection of the amount of tax chargeable on our financial performance. Therefore, there's a need for an adjustment. the adjustment that we are going to make in order to realign the current tax to what would be the tax on financial performance, which we call income tax, is what gives rise to the recognition of deferred tax. Therefore, we could conclude as thus, that deferred tax is an accounting measure that is used to match the tax effect of transactions with their accounting treatment and impact, and thereby produce less distorted results. Which means, in that case, I can summarize as thus to say, deferred tax is no tax. Why is it not a tax? It's because it's an accounting measure that tends to reflect the future tax consequences of transaction that is carried on today in the financial statements. Which means the essence of deferred tax is to cover for the gap that exists with current tax. Why? Because current tax take cognizance of the tax rule to more or less determine the amount of tax that affects taxable profit, or a portion of taxable profit that is due as tax payable to the government for the financial year. But that doesn't necessarily reflect all of the tax impact that will be attributed to accounting performance. Why accounting performance is determined based on profits, which we call accounting profits. And in today's world, accounting profit is made up of more or less profit for the year and also other comprehensive income, which we call the total comprehensive income. Therefore, what this means is that if we only go by recognition of current taxes in our financial statements, there will be mismatch, or because there are some tax consequences that has not crystallized, even though they might have been triggered by current period transaction, which has been reported in the current period financial statement. Therefore, in order not to mismatch, and in order to more or less embrace the accurate principle of accounting, what then we do is to ensure that we accrue for the tax impact that has not been taken into consideration by the current tax computation. And that impact that is not taken into consideration is what we call future tax consequences. And the recognition of such effects as it affects taxes is what we call deferred tax. And that is what brings about the recognition of deferred tax. All what I've explained are still technical, but we are going to bring it to a granular level, which means deferred tax is no tax because we try to only create a completeness in the recognition of taxes in our financial statements. And I'll put up a diagram for us to explain what it is again in a layman's language. Now, let me go to my whiteboard. We want to introduce deferred tax. Now, let me assume let's assume that this is a road within a community. Now, this road is no longer motorable in the way and manner we desired it. Therefore, what do we do? Therefore, we try to smoothen the road, pending when government will construct the road at a later date. Therefore, to smoothen a road, you need to grade that road. And grading of a road implies that you do this. Doing this, what he has done is that areas where you have excesses, these areas, you scrape it and use it to fill areas will have potholes. You again take from these excesses, which is like a hedge, fill this pothole. You take from this excess, you fill this, and you do this. At the end of the day, what you now find out is that by the time you do that, you now have a road that is as motorable as this for a while. Something close to a straight line. Because we pick from these excesses to fill in all this. At the end of the day, if you have seen where roads are graded, you see that they more or less put a measurement to the tractor and start to take from those who have excess, use it to sand fill, those who have potholes, and we come up with this straight line. Now, that is similar thing we need to look at with respect to deferred tax. That at some point in time, let's say in a year when your income tax supposed to be 30, current tax was 20. When it's supposed to be 40, current tax was 50. When it's supposed to be 30, current tax was 35. And when we look at it like that, these differences arose as a result of something. And that is what we want to look at. To say, rather than recognize current tax, what we recognize is income tax. And what is the difference between current tax and income tax? The difference between income tax and current tax is the deferred tax. Now, if you recall, we said income tax or income taxes is made up of the following components: current taxes and deferred what? Tax. But the beauty of it is that deferred tax can either be plus or what? Minus. Why is it so? It is so because deferred tax, as we have said earlier, is an accounting measure which serve as what? An adjustment, or simply put, accrual adjustment. And that is what we'll break down today. The journey will take us some time, but we'll start it today. As you are all aware, the journey of 1,000 miles begins with a step. Now, deferred tax takes two sides to a coin. Deferred tax could be deferred tax asset, which in short form it can be considered DTA, and it could be deferred tax liability. Okay, at least we understand what an asset is, and likewise what a liability is. But the only thing that is left to be defined is what is deferred tax itself, and when can deferred tax be an asset, and when can it be a liability. Now, I will start with this simple diagram. And I want us to appreciate this diagram, which will lead us to answering some questions. Deferred tax. Deferred tax arose from a temporary difference. That means in the bid of understanding what deferred tax is, we need to first of all recognize what gives rise to it, which is temporary difference. But unfortunately, at this point, we don't even know what temporary difference is, which means the first question that comes to mind is, what is a temporary what? Difference? This is the first question we tend to answer. You know, in the bid of solving a problem, you come across some other problems. But without solving those other problems, you might not be able to solve the real problem. Also, we are made to know that in every coin has two sides. And that can be likened to the fact that temporary difference is said to be either taxable or deductible. Now, that now leads us to the second question that is begging for an answer. What is the second question? The second question is, when is a temporary difference A, taxable, and B, when is it what? Deductible. That's the second question. This is also in a bid to understand deferred tax. We are made to know also that the routes we pass with respect to taxable temporary difference will lead us somewhere. And we are told that it leads us to the recognition of deferred tax liability. Which then means that if that is the case, a question begs for an answer. And before the question, we are also told that deductible temporary difference lead to the recognition of deferred tax assets, DTA. Now, the third question then is, how is deferred tax liability and deferred tax what? Assets determined? That's a question mark. But in the interim, somebody whispered to me that taxable profit is not the amount of tax. Rather, is a portion of that profit that is paid as tax. And what determines the portion of profit, taxable profit paid as tax, is based on a tax rate as pronounced by relevant tax law. The same thing can be likened to this, that taxable temporary difference and deductible temporary difference are not necessarily deferred tax, but a portion of them is what is recognized as deferred tax. And that portion, what determines it is the tax rate, which means the question then is, there's a tax rate that have to be applied. Now, which will lead us to our final question. What tax rates or rates is or are applicable? If we're able to provide answers to these four questions, that will open the door for us to appreciate and understand what deferred tax is. But we'll take note of these points, which I've mentioned earlier, and we'll come back to it by the time we demystify the position of the standard. And what is it? Key points on deferred tax. The first point is that we said deferred tax is not a tax. Deferred tax is not what? A tax. 2, we said deferred tax is an accounting measure. Accounting measure means it is a mere estimate for accrual accounting or accrual purposes. 3, that the whole essence of deferred tax recognition is to reflect or capture the future tax consequences of current period what? Transactions and events. And the essence of capturing this is to serve as an accrual adjustment to current taxes for completeness. Thereby incorporating all tax impacts. Now, by the time we finish our discussion, we'll be able to answer, we'll be able to relate with these 4 cardinal points that deals with deferred tax. First thing, which is surprising to even myself at this first point, is that deferred tax is not a tax. Why? How? These are the questions we answer. 2, it's not a tax, but is an accounting measure, which you call a mere estimate for the purpose of accrual basis of accounting. Okay, why are we doing this? We are told that it's to reflect future tax consequences of current period transactions and events. What happened to current tax? Why is current tax not reflecting it? The next one is that we are doing this because we need that adjustment to force us to recognize, for completeness sake, the entire impact of taxes on our current period transactions and events, which means our current tax is not a reflection of our income tax for a period. Rather, we need an adjustment which can be positive or what? Negative on our current taxes in order to bring it to the level of our income tax. And that speaks to the fact that here, as I've said, deferred tax could either be positive adjustments or what? Negative adjustments. Now, let us start the journey. The first question that came into play is this. What is a temporary difference? And the second question is, when is a temporary difference taxable and when is it deductible? Third, how do we determine deferred tax liability and how do we determine deferred tax assets? Fourth, what tax rate should be applied in order to determine deferred taxes? Now we'll pick it one by one. Temporary differences. Now, temporary differences are differences between the carrying amount of assets and liabilities when compared with their respective tax basis. What does that mean? It means where carrying amount is equal to the tax base of assets and what? Liabilities. In this vein, we say there is no temporary what? Difference. Here we say what? No what? Temporary difference. And this situation, where does it occur? This situation, this instance, this situation occurs when any of this occurs or happens. One, when accounting principles of treating a transaction agrees with the tax treatment of that transaction. And secondly, this also happens even where the accounting and tax treatment are different, but such difference is considered permanent. Where there are differences in tax and accounting treatments, of transactions, but the differences are permanent in nature. And later on, we will explain when differences are permanent in nature, otherwise known as permanent differences. Now, this situation will not give rise to temporary difference. But when do we have temporary difference? Temporary difference arose from this instance where the carrying amount does not equal the tax what? Base. of assets and liabilities. In this instance, what this will result to is a temporary difference, which means temporary difference are differences between the kind amount of an asset and liabilities and the tax base of that asset and of that liability. But where the two are the same, there are no temporary differences. And they can only be the same where either of these two occurs. One, accounting treatment given to a transaction is in tandem with the tax treatment. Or where the accounting treatment is not the same thing as the tax treatment, and that treatment or that difference is considered to be permanent in nature, or because such will not reverse at any time in the future. Whereas temporary differences are those differences emanating from the fact that the amount in which an asset or liability is recognized for accounting purposes is not the same as the amount the assets and liabilities are accounted for or measured for tax purposes. And that is that. And from the word temporary, what it means is that such differences, though it exists, but it is not permanent, because permanent differences will not reverse at a later date, but temporary differences will reverse at a later date. Does that make sense? And that is it. Any question? Okay. You can raise up your hand if you have a question, or you can unmute yourself. Any question? Okay, can we put up our cameras except for a narrow? Because a narrow had issue with the camera, which I can also see from here, because it's not popping up camera at all. But Donka, please endeavor to put up that. And also, Gbemi is not where she could put the camera. Therefore, those two people, Enaro and Gbemi, are exempted. But Donka, we are waiting for you. Okay, and any other person in that shoe. Okay, if that is the case, I think we'll try to answer the first question. But as time goes on, we are also going to illustrate it with practical scenarios. The second question is, when is a temporary difference taxable and when is it deductible? When are temporary differences taxable? Now, I'll break it down like this. Temporary differences are taxable if the difference or the differences if the difference or differences will result in higher taxes in the future periods as a result of current transactions and events. What it simply means that if we have a temporary difference, and the impact of the temporary difference is that in future, it will expose us to higher amount of taxes. Such a temporary difference will be concluded and considered as a taxable temporary difference. What taxable means you will be hit by additional burden of tax. That's what taxable means. And when does this happen? When does it happen that we find ourselves in this situation? We find ourselves in this situation in either of these instances. A situation where the carrying amount of an asset is higher or greater than the tax base of the assets. What it simply means is that, let's say a motor vehicle has its carrying amount which is the book value, net book value, to be 1,000 naira. When its tax base in this case is the tax written down value after deducting capital allowance. Remember, carrying amount of motor vehicle is after deducting depreciation, but tax base for motor vehicle is after deducting capital what? Allowance. The tax base is 800. Hence, the temporary difference of 200 is taxable. It's taxable because the carrying amount of that asset, which is 1,000, is higher than the tax base of that asset, which is 800. Also, it could happen with respect to liability. Remember, it's both asset and liabilities that give rise to deferred tax or to temporary difference. Now, it could happen in this situation where the carrying amount of a liability is lower than the tax base of the liability. Now, in this case, what are we saying? We are saying that if we have a liability, for example, a provision as a liability with a carrying amount of, let me say, 400 in line with IS 27. That's right. What is it? Razor with IAS 37. While its tax base is 0, for example, for tax what? Purposes. Therefore, in that case, we say the temporary difference, sorry, okay, okay, let me say the tax base is not 0, it's higher, it should be higher. Let me say the tax base is the tax base is 500. Therefore, the temporary difference of 100 is taxable. It's taxable because the carrying amount of 400 is lower than the tax base of 500. This 100 is taxable. Now, that is from the angle of when are temporary difference what? Taxable. I repeat again. Temporary difference is taxable if the difference will result in higher taxes in the future periods as a result of the current transactions and events. And when can we identify this clearly? We can identify this under 2 instances. The first instance is with an asset. The second instance is with a liability. Now, the first instance with an asset, at what point is it taxable? Is when the carrying amount of that asset is higher than the tax base of the assets. But at the instance of the liability, it is when the carrying amount is lower. And we're going to see that as we move on. Now, remember, the question still is, when is temporary difference taxable and when is it what? Deductible. Now we can answer the aspect of deductible. When are temporary differences deductible? Temporary difference is deductible if the differences will result in a reduction in amount of taxes in the future periods as a result of current period transactions and events. That means that whenever your difference will impact your future taxes so that it makes you pay lower taxes in the future, such difference is considered deductible. As we've done for taxable, we also do for deductible. And what is that? When is it going to be deductible? When will it happen? There are two instances that will happen. For an asset, how will it happen? For an asset, it will happen where the carrying amount of an asset is lower than the tax base of the assets. That is where it could happen. Example. If we have a property with a carrying amount of 10,000 and a tax base of 12,000, then the temporary difference of 2,000 naira, which is the difference between the two amounts, is deductible. And I'm going to show you some relationships. But what if it's a liability that we are assessing? If it's a liability, the situation will be where the carrying amount of a liability is higher than the tax base. Let me give an example. E.g., provision of 1,000 in the financial statement, but a tax base of 0. Hence, what do you have? Temporary difference of that 1,000, which is the difference between 1,000 and 0, is deductible. Let me repeat it again. When is temporary difference deductible? It is deductible when the differences will result in a reduced amount of taxes in the future. And this reduction is brought about as a result of current period transactions and events, which will impact your future taxes and reduce them in nature. And we're going to see that. Now, to see that or to evidence it, we'll consider it from two perspectives. If it's from an asset, how does that happen? It happens when the carrying amount of that asset is lower than the tax base of the assets. And I give an example. A property that has a book value of 10,000 naira, but has a tax base of 12,000 naira. At that point in time, that difference of 2,000 is considered deductible. And we're going to see that later. But for a liability, reverse is the case because it's only deductible when the carrying amount of a liability is higher in amount to the tax base of that liability. And in this case, a situation where we have a provision made in our financial statements in line with IAS 37 for 1,000 naira, but the tax base of such is considered to be 0. Therefore, we have a difference of 1,000 naira, and this difference is considered deductible. That will now make me to summarize all what we've said using this matrix. I call it deferred tax matrix, which can also be considered as temporary difference matrix or temporary difference matrix, anyone you call it. And what does it do? Let me assume it's a 3x3 matrix. 3x3 matrix means you have 3 columns and you have 3 rows. Now, deferred tax or temporary difference emanates from 2 factors. The first factor is the Okay, sorry for that network failure. Automatically, once there's a network failure, I switch. Okay, I believe you guys can hear me now. Okay, as I was saying, equity is a component or is an element of financial position alongside assets and liabilities. But deferred tax do not arise on equity. It arises only on assets and liabilities. And we'll explain as time goes on. Now, it arises on assets and liabilities only where we find ourselves in this instance where carrying amount Let me use a smaller pen. Where carrying amount I'm not writing it well. Pardon me. Is another skill to use this pen to write. It's tedious, but it's something that you get used to over time. A situation where carrying amount is greater than tax base, and the opposite situation where carrying amount is less than tax base. Now, let's go back here. We said a situation where the carrying amount of an asset is higher than the tax base of an asset, we said it is taxable. Now, where does that fall there? This is an asset, and here, carrying amount is greater. Here, carrying amount is what? Less. But we said it is only taxable when carrying amount of an asset, it's not showing my highlighting. Okay, it's showing now. When carrying amount of my asset is greater than the tax what? Base. Therefore, this is my asset, and this is where the carrying amount is greater. Therefore, at this point, I say it is taxable. Now, to also play a simple analysis. Now, if we conclude that where a carrying amount of an asset is greater than tax base, that it is taxable, temporary difference. What if it is a liability we are talking about, not an asset, but the carrying amount is greater than tax base? It will be opposite of what an asset is. Therefore, in that case, we will say it is deductible. And that's why if you come down here, you can find it here that it's become deductible for a liability whenever we find ourselves in this situation. It becomes what? Deductible, because the carrying amount of a liability is higher than the tax base. Therefore, it becomes deductible. Can you see it here? Now, also, if for an asset, we have concluded that where the carrying amount is greater than tax base is taxable. What if for that same asset, it is less than or lower than that? It won't be taxable, it will be opposite. And that is what we speak to here. Where the carrying amount of an asset is lower than the tax base, it becomes what? Deductible. Here is deductible. Now, if for an asset where carrying amount is less than tax base, we conclude that it's deductible, what will it be for a liability? It will always be opposite of what an asset is, which is what we agree here to be, that it will be taxable. because the kind amount of that liability is lower than the tax base. And therefore, here, I come here to say this will be taxable. Which means at every instance, this diagram will always give you the direction of the temporary difference, whether it is taxable or it is what? Deductible. But the next hurdle we cross, which was not part of the initial question, is tax base. Kind amount is not new to us as financial reporting experts, because kind amount is simply the amount at which you recognize an asset or liabilities in your books or in your balance sheet in line with relevant IFRS. But the one that we need to now take note of, which is determined with respect to the rules of taxation, is the tax base. Now, what is the tax base of an asset? What is the tax base of a liability? These are the questions that need to be answered, which means there's the fifth question there that we need to take into consideration. What is the fifth question? The fifth question is, what is a tax base? What is a tax base? Any question at this point? Before we move further. Any question at this point before we move further? Any question at this point before we move further? Now, I'm going to divide us into two groups. Let's make a summary of what we have understood so far. Let's try and brainstorm and discuss on one thing or the other based on what you understand before and what we have discussed. And from there, I'll move it up to the next level because we still have two questions to answer. The first question is, which tax rate is relevant or applicable? And then the last question is, what tax base? What is a tax base? And how do you determine tax base for various assets and different liabilities? Okay, in that case, I'm going to divide us into groups. We'll just break out for 5 to 10 minutes and we'll come back. You can join your group now. Thank you very much. Okay, welcome back, Paul. Okay, welcome back. Group one, who is presenting for you guys? And that person can present now. Your understanding so far for deferred tax.
I'm presenting.
Okay, you can go ahead.
Okay, like there's a general consensus in my group, and the consensus is that this is a kind of refresher course, that it is an refresh, that our memory is being refreshed from one or two things we have learned about deferred tax in the past, and that the major takeaway since we started this lecture is the fact that we have further broken it down, demystify it, so that we can easily recollect and understand what the deferred tax is all about now and going forward. And there is also there's also a general emphasis on the fact that deferred tax is not a tax in itself. It's an adjustment. It's an accounting adjustment on It's an account adjustment on current taxes, so that the income tax can properly reflect the substance of the transaction and event that took place during the accounting period. There's also a general emphasis on the fact that the introduction of deferred tax matrix will go a long way to help us to understand the deferred tax very, very well, and for us to easily recollect what you are teaching us. That this matrix is a very good template that can help every one of us going forward. And on a personal note, I said I'm looking forward to the fact that learning the factors from a person that is not only teaching us the factors from what he has read in the book, but from also from a person that has hands-on experience, somebody that is applying this principle in real time. So personally, I'm looking forward to that. And then there's also a question in our group. I don't know whether I can come up with a question now.
Okay, we'll address the question after group 2 presents.
Okay. Thank you.
Okay. Taking it from the top, we started by talking about the component of income tax, which is the addition of, which is current tax and deferred tax. We also went further to say, if you are now looking for deferred tax, we can say your deferred tax is your income tax minus your current tax. We also went further to break down deferred tax into positive or negative, which means it can either be asset or liability. We also mentioned that deferred tax is not an actual tax. In essence, it is just an accounting measure. And that means that it is a mere estimate for accrual accounting. The main purpose, however, is to reflect or capture the future tax consequence of current period transactions and events. We move further to define what temporary difference is, which says that it is the difference between the carrying amount of an asset or liabilities when compared with their respective tax base. I also quickly went to check what tax base is, and tax base is the value of asset of the liability for tax purposes as provided by the relevant tax authority. Now, looking at temporary differences, if your carrying amount is equal to your tax base, we'll say there is no temporary difference. And if there is no temporary difference, that means two things have happened. It means that the accounting principles of treating a transaction agrees with the tax treatment. Or even when the accounting treatment of a transaction is not equal to the tax treatment, but the differences in question that we're talking about is permanent in nature. And if it is permanent in nature, it means that it's not going to reverse anytime soon or in the nearest future. We moved further again to talk about when there is now actual temporary difference, which means your carrying amount is not equal to your tax base. And a matrix was designed by Muyiwa to give us like a clearer understanding of how we can recall whether this transaction is taxable or deductible. So if your carrying amount is greater than your tax base, and this transaction is an asset, we will say it is taxable temporary difference. If the carrying amount is also greater than the tax base, but and the transaction is a liability, we will say it is taxable, it is deductible temporary difference. Now, we'll have to turn it all around or reverse the scenario if your carrying amount is less than your tax base and the transaction is an asset, then we'll say it is a deductible temporary difference. Likewise, if your carrying amount is less than your tax base, but the transaction is a liability, then we'll say it is a taxable temporary difference. That is a summary of what we discussed here. However, we were also talking about the applicable tax rates for tax base, which we will need your guidance on. Thank you.
Okay, thank you very much. Question from Group 1.
Okay. Yes, the question that came up is this, that deferred tax, does it only apply to, as in we mean temporary difference, does it only apply to asset and liability? We want to know whether it only applies to asset and liability only, or asset, liability, and income statement elements as well.
Okay, first, it's only attributable to assets and liabilities. Why? As we move on, you'll see that there are two approaches to computation of deferred taxes. There's income statement approach and there's balance sheet approach. Income statement approach determines temporary difference from differences in impact on accounting profits as it differs from impact on taxable profits. While balance sheet approach deals with differences from carrying amount and from tax base. Why is this difference? Because not all transactions that give rise to deferred tax passes through profit or loss. Remember, there are some transactions that impact equity through other comprehensive income. Remember that there are some transactions that impact equity directly and does not pass it through profit or loss. That doesn't pass through other comprehensive income, but of which they have tax consequence on them. And that is one of those things that we need to take into consideration. Is that okay? That is one. Now, again, when you look at asset and liabilities, your income and expense you are talking about is a product of the movement in asset and liabilities. Remember, from the conceptual framework, we define an income as an increase in an asset or a decrease in a liability, which brings about increase in equity other than contribution of additional capital by equity participants. And conversely, we define expense as a decrease in assets or an increase in liability, which brings about decrease in equity other than distribution to equity participants, which means there is no income you recognize and there's no expense you recognize, which is not attributed to activities that surrounds recognition of assets and liabilities. I think I'm clear about that.
Very clear.
Okay.
Very clear.
That answered that question. Group 2, also, you wanted to ask me a question when I visited you, but I said question is meant for the general assembly. I'm not supposed to partake in your discussion at subgroups. Okay, can you bring the question to the floor now?
We want to ask you the applicable tax rate for tax base.
You want to what?
Ask on the applicable tax rate for tax base, on tax base.
Okay, I won't say that's a question because that is what, you know, before we went on the subgroup level, we said we have two questions still begging for answers. The first one is, if you remember, let me take you up. The first one is, which tax rate is applicable? Okay. What tax rate is applicable? And the second one is, what is a tax base? Okay. That is where we'll be getting to as we move on. Now, who can tell me what a tax rate is before we move on? What is a tax rate?
A tax rate is the percentage applied on a tax base as determined by the relevant tax authority.
Okay, can somebody rephrase it? Can somebody rephrase it?
Tax rate is a percentage of your profits or your taxable profits that you are going to pay to government.
Okay. Can another person rephrase it?
So I think tax rates is any rate which is used by the tax authorities to determine liabilities of any organization, or like which we also can use the applicable tax rate generally, which we also can use when preparing our financials.
Okay, the last person. The last person.
Tax rate is like the ratio at which a business or a person is taxed.
Okay. For the purpose of our discussion, can we say tax rate is more or less like representing a fraction that determines the portion of your taxable profit that will be paid to the government as tax? Which means if government says, I want half of your taxable profit, that determines the tax rate, which says 50%. If government says, I want quarter of your profit as tax, that is what forms the tax rate of 25%, which means it's simply the proportion of your profit that will be paid as tax. That's what tax rate really means, which means I want us to look at it from the concept or from the more or less practical aspect of understanding what it is, because tax rate is not arbitrary. There's something that influences the decision of saying tax rate is 30% is this. Do you get what I'm saying now? Which means government might look at, okay, in the economy, for us to rejig the economy is for us to make more money available to the company in order to do more business. Therefore, to do so, what do we need to do? Is that, okay, can we just take 1/5 of the profit so that 4/5 of that profit is available for them for reinvestment or distribution and create more activities? And that's what will now bring the conclusion to say, okay, let us reduce the tax rate from 30% to what? 20%. If that is the case, therefore, what tax rate is applicable? I'll take us through this diagram. There are two perspectives to viewing tax rates. One, we are going to look at it from the angle of, what will I call it? I would call it mode of recovery or settlement with respect to assets and liabilities. And under that, there are two ways to which tax rate is determined. Assets and liabilities are recovered either through use an asset can be realized either through what? Disposal. Which means, for example, let's pick assets, for example. How do you recover the economic benefit of an asset? Is either you use the asset, you put it to use, and it generates economic benefits, or you dispose of the asset and realize or accelerate the recognition of that economic benefit immediately. The alternative to that is that you can also look at the nature or the statute, which speaks to, are you referring to enacted tax rates, or are you referring to substantively enacted tax rates? And these are the things we are going to discuss now. Now we are going to practicalize it. Now, let's pick, for example, if an asset is put to use and it generates income, whether as revenue or as other income, in Nigeria, that will contribute to your taxable profit. Do we agree? Do we agree? I want one or two people to answer. If you put asset to use and generate income from that asset, will it contribute to your taxable profit?
Yes.
Okay.
Yes.
And if you contribute to your taxable profit, what will be the rate of tax that such a company will be subjected to in Nigeria if it's not a small company?
30%.
30%. But if rather than use the asset to generate income, you decided to dispose of the assets and you made a gain on disposal of that asset, will it contribute to your taxable income, taxable profit?
Yes.
Will it contribute to your taxable profit?
Yes.
That's not correct.
No,
Based
because
on our
it has
lesson
been
of yesterday.
disposed.
It's not going to contribute to your taxable profit.
Disposed.
Rather, it will contribute to your chargeable gain,
It's not correct.
which is not under company income tax.
Yeah.
And the rate for chargeable gain is 10%, which means the rate is a function of the mode of recovery of the economic benefits. When the economic benefit will be recovered through disposal of an asset, the relevant rate of tax in Nigeria is 10%. But if it will be recovered through use, such that it generates economic benefits, it will be subjected to tax under company income tax rate at 30%. Am I making sense?
Yes, yes,
Yeah.
yes.
That is what that means, which means the rate you will use is a function of, is this something that contributes to a taxable profit or something that contributes to another basis of profit, which are subjected to different tax regimes? That is on one side. Now, let us even say it is only going to be for use and it's 30 what? %. The next question you ask yourself is this. The rate you are going to use, that is 30%, is it an enacted tax rate or is it a substantively enacted tax rate? Now, how to put it to you? Have you ever heard of this phrase before, enacted tax rate and substantively enacted tax rate? Have you heard of it before?
No, sir. No, sir.
Now, if you have heard of it before, can you contribute to it before I break it down? You can unmute yourself. I think I've granted you guys access. Let me check it again. I've allowed you to unmute yourself. Okay, who can explain from the person's perspective what is an enacted tax rate and what is a substantively enacted tax rate? No idea? Mr. Yodele, you are just joining us. You are just joining us for the first time today. Can you put up your camera? Hello, sir. Two people are not putting up camera because they are not where they could put up camera. Mr. Yodele, let us meet you so that other members can know you. We are one family. If you are there, just do that, please. Thank you. Now, since nobody's ready to answer, let me try and explain it. The ruling tax rate, which is the tax rate that is currently enforced by legislation, is an enacted tax rate. In Nigeria, for company income tax, the enacted tax rate for companies is 30%, and for small companies is 20%. And for very small company that is less than 25 million naira is 0%. That is enacted tax rate for company income tax. The enacted tax rate for capital gain tax is 10%. The enacted tax rate for tertiary education tax is 2%. The enacted tax rate for information technology development levy is 2%, is 1%. Now, if that is enacted tax rate, what can there be a substantively enacted tax rate? Who will give an idea of that? Since I've told you what enacted is, which means the ruling, the current, the existing tax rate according to law, which is applicable for payment of your taxes in the current period as they fall due. Therefore, what can now be a substantively enacted tax rate? Olawale.
Yes, sir. I was thinking through a revised rate by the law through court injunction. That's what came to my mind, sir.
Can you put that court injunction? I didn't get it. Can courts? Can you explain it?
Can I try?
Okay, Mr. Duncan, assist me, sir.
Let me try. Substantive enacted tax rates, if I may use my understanding, it means two things. Firstly, either a tax rate according to a law that has been amended but is yet to take effect. Maybe it's going to take effect from the future financial years, or tax rate that is already being used, though is yet to be fully backed by law. That is how I understand them.
I want to try. I want to try. Okay. I don't know why it's the same thing with what some people call estimated tax rate. And if it is actually estimated tax rate, and it is usually the actual tax, the proportion of the actual tax over the income or profits. Like, okay. Let us say, for instance, for the purpose of income taxes, for instance, income taxes, like we have been taught, is a makeup of current taxes and deferred tax. And at the end of the day, when you add the two together and divide it over the accounting profit, probably before tax, that's, I don't know whether it's that, it's just a fire chart. The proportion of the actual tax over the income or over the accounting income or accounting profits.
Okay, let me try and break it down. Substantively enacted rates, okay, speaks to the fact that tax legislations are subjected to changes, which means there might be pronouncement today that new tax rates will be announced. And that tax rate may take effect at a later date. In a situation where government announced that by 2022, tax rate will be reduced to boost economic activities from 30% to 20%. And today is March 2021. Today is January 2021. Today, our enacted tax rate is 30% because that's still what is applicable today. And today, our substantively enacted tax rate is 30%, which is the rate applicable in the future. Because by the time we get to 2022, which is the future, our rate is now going to be 20%. That 20% is a substantively enacted tax rate, while 30% is an enacted tax rate. But in a case where there's no new pronouncement, you have no substantively enacted tax rates. You only have substantively enacted tax rates when there are new pronouncements which does not take effect immediately, but will take effect at a later date. And why are we discussing this? Because for deferred tax computation, it is talking about future tax consequences. Therefore, we are now going to be faced with which rate are we to apply? Is it the one for the future or is it one for today? And that only takes place where there's a change in basis of determining taxes, which is the tax rates. Does that make sense now?
Yes, sir. Makes sense now. It makes sense now. Makes sense.
Okay. Can we go on break now for 5
Yes.
minutes? Thank you very much. Welcome back. We are going to go on with this tax because we have laid a simple foundation, and the tax is as going to be shown here, which is part of the material we've sent before, and I can still share it again. You go, I'll send it to the WhatsApp group. You will attempt solving these questions. Question 4, which speaks to deferred taxes. Question 5, which speaks to current taxes. Though we have not discussed tax pays, but I want you to attempt, based on the material which you can consult, and attempt to answer question 6 with respect to tax basis, because that will be our starting point in the next section. And try to answer question 7 which is going to lead us to something else. I think that is where we'll stop now. And the essence is that deferred tax is an interesting discussion and which we have to take on a systematic basis. Now, we've discussed this so far, and you have an opportunity of the recording where you can listen to it again and move on from the perspective we stopped and from where we stopped. If we have any general question at this point, can we ask now? Can we ask now? Any questions so far? If there are no questions, okay, I'll send this material to your WhatsApp and we'll pick it up from there. Okay, thank you very much. Next section is next week, Saturday, 10 a.m. But we'll start from where we stop by evaluating individual contribution and answers that is coming from us. Thank you very much, and God bless you.